Access Holdings has entered into various pacts with Standard Chartered Bank to acquire the British bank subsidiaries in 4 African markets. The news announced on Friday signals Access Holdings' most aggressive push for expansion beyond its home markets of Nigeria since it commenced operations in the country in 1989 as Access Bank. Standard Chartered's banking operations in Angola, Cameroon, the Gambia and Sierra Leone are up for sale as Access Holdings is planning on entering 26 markets by 2027, compared to the 17 countries it operated in as of January 2023. Economists see this as a daring move for the lender to venture into countries that Standard Chartered, widely acknowledged as one of the biggest European banking investors in Africa, sees as low-impact financial markets. Joining me for this conversation from London in the United Kingdom, I believe I do have economist Dr. Andrew Nevin. Let's see if he's on the line with us. Andrew, are you with me?
I'm right here. Tolulope.
Fantastic. Andrew, welcome once again to Business Edge. Thank you so much for joining me.
Oh, it's always great to be with you. Good morning.
So let's look at the first sort of news that came out. This news came out on Friday. Very big news here in Nigeria's financial market. So acquiring Standard Chartered subsidiaries in 4 African markets is no small feat. So when we look at the reason that Standard is then exiting these markets, calling them low-impact markets, and Access is entering them, is there something that Access is seeing that possibly Standard didn't?
Well, I mean, to begin with, Access Bank, I mean, it's been an incredible success story across Nigeria and across the continent. I mean, I remember when Access took over Intercontinental, which was one of the banks taken over by the CBN in 2009, the largest one, I think. And it's just the sheer audacity of that kind of takeover, making it a success, taking over Diamond Bank, becoming the largest bank, and then marching across Africa in recent years, including buying a bank in South Africa. So we tend to think of the South African banks as the big players, but Access and certainly UBA have ambitions to be the Pan-African players. And I would never bet against Access Bank. I mean, those old enough will remember that Access Bank was not even the 100th largest bank in the country in the 1990s. I mean, it's seen incredibly well managed, judicious moves through acquisition, audacious moves. And this is a logical step for them to create a Pan-African bank. With respect to Standard Chartered, I think what is fair to say, not being critical of them, but I mean, they've had their challenges coming out of the financial crisis and issues around compliance, and they've really decided to focus more on Asia and the Middle East. And so in Africa over the past decade, I would say they haven't really been very active trying to build. So I think it's logical for them to exit these markets. So I don't think it's a reflection on the future of Africa. I think it's just a reflection on Standard Chartered's strategy. So we're moving these assets, these banking assets, from a bank that's not that interested in Africa, or at least not showing its interest, to a bank that's very interested in Africa. So it should be good for all parties.
All the parties involved. So let's talk about some of that goodness. So Access Holdings will be buying Standard Chartered's subsidiaries in Angola, Cameroon, the Gambia and Sierra Leone as well. While Standard may have its own definition of what kind of business it wants to do, as you've pointed out, we see what Access is doing with this aggressive move into the Pan-African market. So what are some of the macroeconomic factors that you're seeing in some of these African countries, again, Angola, Cameroon, the Gambia, Sierra Leone, that could make them attractive for such long-term investments and expansion from a bank such as Access Holdings?
Well, Access Bank is very strong in the retail franchise. I mean, certainly the largest bank by assets in Nigeria and expanding across the continent. And I mean, I think in many markets, it's the retail bankers, the dominant retail market bankers that really do well. And there's more money in Africa than is stated in the official statistics. I mean, because the informal economy is so large, remittances are so large, these things are not picked up in the official statistics. So I think Access Bank sees the potential for that. And then, of course, we have the AFCFTA, which every country is going to participate in. So I think there's a lot of positives, but there's also some challenges. And I think that for banks that have tried to enter markets with outside their home language, so that is for English-speaking banks like those in Nigeria trying to enter Francophone or Lusophone areas, and vice versa for Francophone banks to enter into Nigeria or to Kenya, has been a challenge. And it's not easy to knit together. I mean, if we look at EcoBank, and I've been a huge fan of, supporter of EcoBank over all 15 years. I mean, they have always had this Pan-African ambition. And of course, they're in, I think, 33 countries, so more than Access Bank is even getting to with this, with 26 banks as their ambition. But EcoBank has had the challenge of kind of trying to integrate these multiple languages, multiple different legal systems, multiple different ways of banking. So it's not easy. So I think Access will do a great job, but they're taking on something that's not simple. But given AFCFTA, given that we're richer in Africa than we're often purported to be, I mean, I think they could build a very good business in all these markets.
And I like the fact that you talk about what's off the record or sort of off the data that we typically see. But you did mention challenges. And Andrew, I quickly want to go back to that. The language one was one of those that you mentioned. But with Access aiming for some 26 markets by 2027, what are some of the challenges you see Access Holding facing? And not even just Access. We know that there are expansion plans for many financial institutions and businesses across the continent, but there are local contexts and there are local issues sometimes that may stop these businesses from being able to thrive when they do expand. So in terms of Access Holdings, in terms of big financial institutions looking to expand, what do you think some of the challenges they need to take cognizance of are in the coming years as they do these expansion drives?
No, I think you kind of hit it on the head here. In addition to kind of the language issues and the different legal systems, what you often have, I mean, obviously, if you're trying to create a Pan-African bank, what you want to have is a similar way of doing things across all the countries, similar systems, similar products to the extent possible, and being able to pool your resources in a way to get economies of scale. So if you've got 50 million clients across Africa, you're serving them in the same way. The challenge there, though, is the local regulators often create rules that are specific to the local situation. I mean, a simple one, for example, is the data storage. So they all, obviously, if you have 50 million clients across Africa, you'd like to have one large data center, one or two backup data centers. That really is economically efficient. But what's going to happen is the regulators in each country are then going to ask you to keep the data within their countries, and you lose that efficiency. Similarly, in the way that you file, you keep track of your compliance, you keep track of your regulatory capital. Every country does a little bit differently. So again, you'd like to have this consistency so you can have one compliance function, not one compliance function, but the same compliance approach in every country, but they all impose different ways of doing things. But I mean, I think this is a general problem across Africa. I think we all understand for Africa to make progress, AFCFTA to be successful, there has to be a harmonization across standards. That includes not just things like the financial sector and banks, but also includes telecoms, includes pharmaceuticals, includes food safety, all of those things. We're not going to get the benefit of a Pan-African integration. Every country continues to have local regulations for things. And if you're a country of 5 or 10 million people, it's very expensive to create your own set of regulations for something like food safety. We'd be much better off, pooling our resources on our continent and saying, we're all human beings. The food safety applies to all of us, and let's have the similar food safety. And it's similar with the banking as well. It's costly to kind of try to comply with all the different regulations that local regulators and local central banks impose across the continent.
Okay, so I want to go back to Standard Chartered very quickly because last year it did announce that it had the intentions to exit 7 countries in Africa and the Middle East as well. It's not just Africa, where it considered its operations to be subscale and also focus on markets of greater potential. That's a business decision that Standard Chartered has made. But do you think there are any lessons or learnings in the exit of Standard Chartered from the Middle East and from African countries it's operated in that we should take away from this situation?
Well, I think it maybe highlights a little bit what I was saying just previously. Because of the increase in banking regulations after the 2008 great financial crisis, what's happened is it's more expensive to run a bank in any country. So when you have subscale banks, you have all of the high compliance costs, anti-money laundering costs that have really driven up the cost of banking. So if you're subscale, your incentive to exit is much higher. So whereas in the 1990s or early 2000s, you might have just stayed in the market if you were break even because there was no particular pressure to exit. But with the cost of being a bank going up in every market, the pressure to be number 1 or number 2 or number 3 is simply a lot higher. So it's not a big surprise that Standard Chartered has said, look, we're going to exit these markets and focus on our big markets, which are the ones in Asia. And again, in the Middle East, they're exiting, I think, a couple of markets, but they're staying in the big ones. So Saudi Arabia, UAE, which are core markets for Standard Chartered.
All right, so with one more thing on this access issue. So the takeover of the African Banking Corporation Limited in Tanzania, that one is almost complete. There's a definitive agreement already in place. And part of the deal also incorporates Access Holdings' purchase of Standard Chartered's customer private and business banking units in the country as well. So we know that the banking regulator in Tanzania has given the deal the seal of approval, the green light. It now remains the Central Bank of Nigeria to be able to approve the transactions. In terms of what we should expect from the CBN, because there seems to be a timeline to all of this, Andrew, looking at having all of these deals delivered in the next 12 months, what's sort of the process on this side of things that will know that Access Bank or Access Holdings will be able to sail through and get the green light from this side?
Well, you never know when you have to go through a regulatory process. And of course, when you have the purchase and sale agreement, it just says it's subject to getting approvals on that. But the process that's Access Banking going through is standard. So, I mean, you're a banking group. Banking is it's highly regulated because it deals with people's money, people's deposits. And, you know, we've gone through banking crises here in Nigeria. Not the last one, but I understand the previous ones where people lost their deposits. So regulators are very careful to make sure that when there's a takeover of banks, that it's taken over by people that are appropriate to be running a bank. I think in the case of Access, you know, that is not going to be an issue. Obviously, the Tanzanian authorities have already granted permission to go through with the takeover on that, and I suspect the CBN will too. But the other issue, in addition to being the right people, is just everyone's very concerned about capital adequacy. So they're going to be asking questions around how is this funded? Does it affect the capital adequacy of the other units, particularly the Nigerian units? But if the Access Bank satisfies those asks, then I think it'll be fine for the CBN. And of course, I think everyone recognizes now with AFCFTA, to the extent that we can build strong Pan-African banks, that where someone who is doing cross-border transactions, cross-border trade, can bank with the same people on both sides, it just is going to make it much better for Africa.
Mm-hmm. All right, so let's bring this to the CBN now. I mentioned them, and there's been something interesting that developed because Nigeria's banking and financial regulator has announced a new policy that is looking to restrict the acquisition of controlling stakes in financial holding companies. So any investor looking to acquire up to 5% of any FHC or increase their shareholding already to 5% or more would now need to get prior approval from the CBN. Andrew, there's been some interesting developments in the past few weeks around Nigeria's banking situation and some shares being sold and control happening. Do you think that's where the CBN regulation is coming from?
Well, I won't speculate on the transactions that have happened, as you know, but I mean, I think people need to understand. I think everyone does understand. I was saying before, banks take people's money, so that's a privilege to be able to take people's money. You want people who run the bank to be fit and proper, is the term that's used for that. In addition to taking people's money, banks have one other advantage in this world, which is they create money. So every time they lend, they create money. When the central bank creates money, we call that seniorage. It's also called seniorage for commercial banks, and it's a great privilege. And for both of those reasons, you need to have people that are fit and proper running banks. And of course, the CBN has a long history, certainly the 15 years I've been in the country, a history of the governance issues. This particular governance issue is actually one that's very common, normal outside of Nigeria, and I'm actually surprised it wasn't brought in before. You cannot have a situation where you have to have fit and proper people running the bank, the officers of the bank, but you don't have the oversight of who are the shareholders of the bank. And certainly someone who has over 5% of a bank, a large bank in Nigeria, has significant influence over the bank. So I think it's absolutely the right regulation to bring in that said the CBN has to approve any shareholder over 5%. I think in some markets, in fact, you can't have a shareholder over 5%. The idea is that banks are widely held, usually through the public stock markets in most countries, most larger economies on that. So even to allow the 5% is a little bit of a how will I call it, a concession. But the fact that they have to approve the people that own over 5%, I think is absolutely the right rule, and I'm glad they brought it in. As I said, I'm surprised it wasn't in earlier than this.
And it's interesting because one of the things the CBN circular, which announced that this is going to go into effect on August the 1st, said was that the CBN would also make sure that no one can own a controlling stake in more than one bank except a prior approval is obtained. And subsidiaries of any FHC were prohibited from acquiring shares in its FHC and other subsidiaries within the group. So it's not that you cannot own controlling interest or some shares in more than one bank, but you have to have a prior CBN approval. Andrew, why is this of concern, having people who are able to, yes, if they have the money, have stakes in more than one bank, or at least 5% in more than one bank here in Nigeria? What do you think?
Well, again, I think it's a good regulation because, I mean, if you think about it, the other shareholders of the bank are now at a disadvantage because if I own 30% of one bank and 30% of another bank. I've in a sense created a conflict of interest. I have influence over both banks. How am I going to use that influence? Is it going to favor one bank over another bank? They're in a competitive marketplace. So I don't think you should have individual shareholders who own over 5%. I said, I was surprised they even allow it actually, but certainly they should have required to get permission for that. So again, I think that's a very good governance rule for the peculiarities of the banking system. And it's really there to protect the minority interest of the people who are the other shareholders in the banks that you may have multiple controlling interests in.
It's interesting. So before I let you go, Andrew, let's talk about these financial holding companies that we've seen. In recent times, we've seen some Nigerian banks transits. They've moved to becoming financial holding companies. We just talked about Access Holdings, UBA Group, First City Monument Bank, Stanbic IBTC Bank, First Bank as well, Zenith, GTB. They're all making these moves to adopt this holding company structure. And I think for the benefit of the audience or even some of their customers, what does this do for the banks? Why are we seeing banks move from just being banks to now being holding companies?
Right, so let's just go back in history. When we had the financial crisis in 2009 in Nigeria, what happened was the regulation was brought in that you either had to be a bank or a bank holding company. What happened previously was a bank within the bank might hold an insurance company or an asset manager on that, and that created real problems. We don't have time to go through all the problems. It was the right decision for the central bank at the time to say, you're either a holding company or a bank. Most of the banks opted to be a bank. Only 3 of them opted to be holding companies, which were Stanbic, FCMB, and First Bank. So they were been holding companies all the way through. Then what happened was in the late teens, 2017, 2018, 2019, the banks realized that financial services were changing with the rise of the fintechs. There was more interest in asset management, and they realized there were things they could not do if they were just a bank. So as you exactly said, more banks then became bank holding structures. So Access Bank, UBA, Sterling, and some others on that. And they're all doing it because they want to now compete on a wider field on that. They felt they were not able to compete with the fintechs, not able to compete obviously with the asset managers, not able to compete with the investment banks. And now this makes them more competitive because they aren't making enough money, quite frankly, just from core banking. And that's the reason that we've driven in this direction. I don't think there's any problem with that as long as we have the clear regulations and the separation of the banking activities where you're taking people's money as deposits from the other activities, and you keep them separate. And, it's very transparent what's the bank and what are the other units.
Okay, and just to follow up on that, in terms of it making them more competitive, let's also look at it very quickly in terms of what it offers the customer or their consumers, those who use their products and services. In terms of having these banks now become bank holding companies, how is that better for the consumer at the end of the day?
Well, if it works well, for example, you can have an integration of your banking world with your asset management world. So, for example, rather than holding money in the bank, you can hold it in your money market account in your asset manager. When you need it in your bank account to make transactions, you can have a seamless way of transferring that, or an automatic sweep. If you get a deposit into your bank, you'd be able to have that. So, and of course, some of the banks have also FBN, for example. They might have divested, but originally had a life insurance company. So, you can have an integration of those products. But I mean, this model has been tried around the world. It's been, in some cases, helpful for consumers. It's not clear that you necessarily want to have one organization supplying all the products to it. So we'll see how the market.
Hello, Andrew. Hello, Andrew. It seems we're having technical issues with Dr. Andrew Nevin towards the end of our conversation there. Unfortunately, wanting to get his final thoughts on why these bank holding structures are of a positive thing, of course, for consumers as well. Andrew, are you back with me?
I think so. I mean, I think
no problem. So I wanted you to just wrap up your thoughts on that as we round up the conversation.
I mean, I think there are things that you can kind of integrate that make it better for the consumers, particularly around, say, asset management and the core banking. Or then if you have assets, you can take a loan without any paperwork because you've got assets as collateral on that, and that's worked. But I have to say the evidence around the world is mixed. I mean, Citibank back in the early 90s tried this idea of a financial supermarket, acquired travelers insurance. People old enough may remember that. It never quite worked out. So there's always been this tension between being a pure bank and mixing with other groups. I mean, we'll see what the market says for that. And if people can create products integrating across different financial services as a holding company that are attractive to the market, maybe the consumers will be better off. But the bank holding companies are going to have to prove you're better off staying with one institution, combining multiple products, than having different service providers.
And I think that's really going to be where we see these things and see how they play out in the next 1-2 years, particularly with such a growing number of consumers in Nigeria and such a large number of unbanked Nigerians as well. Are they going to stick to using banks the traditional way they understand it, or follow along with what the banks are now offering as holding companies? Dr. Andrew Nevin, it's always a pleasure. Thank you so much for joining me on Business Edge.
Thank you. Everyone have a great day.
All right, you too. And the conversation with this is going to continue. Now it's on the table, or at least close to the table, of the Central Bank of Nigeria to approve Access Holdings' moves to acquire Standard Chartered Sub-Saharan African businesses in about 4 countries. And those countries, of course, include the Gambia, Sierra Leone, Cameroon, and Angola. Now, Standard Chartered exited these countries, not just here on the continent, but also in the Middle East, saying they were subscale and they were low impact for Standard. But Access may be able to find some treasure where someone else said, I'm done. It's a conversation we'll continue to follow up, of course, landing with the approval that Access needs from the Central Bank of Nigeria. You're watching Business Edge. We have international business headlines coming your way. Then the conversation takes us right here, still in West Africa, but we're heading to Ghana, because Ghana is now inviting domestic bondholders for debt restructuring. We'll bring you the latest from Ghana. Stay with us.